All right, so to get started on our lesson today with evaluating financial statements, you'll need to have a couple of things. Obviously, this video, but also on Google Classroom, you'll see the lesson 4.3 evaluating financial statements assignment. You want to go ahead and click on that Google Doc and open it up. The top half of these first two tables here, you're going to fill in and you're going to use while you're watching the video. Once you're done watching the video, these practice problems, or you'll go ahead and work on these practice problems. And then once we're done, we'll come back together and we'll go over these problems on the bottom. All right, so let's get to it. What is evaluating financial statements all about? Well, we already spent some time evaluating a very important financial statement, which was the income statement, measuring the profitability of a business. So when we evaluate financial statements, it gives us a comprehensive view of the overall performance and the health of the business. And so you can kind of look at it as it's your annual physical. So in this lesson, we're going to evaluate, and we've already evaluated one, but the two major financial statements, the income statement and the balance sheet. So if we think about when we evaluate something, what exactly does that mean? And so you can pause the video here and think about the answer to these two questions. What are some things that you evaluate? Or what are some things that we typically evaluate? It goes beyond just looking and saying, okay, I see that there is this number. There has to be kind of the next level deeper look at not only what this statement says, but what is the story behind these statements. So that's kind of a nice way that I like to think about what does it mean to evaluate? You're looking for the story behind the numbers, or you're looking for the story behind the story. All right, so let's get to it. Again, today's focus is going to be all about the balance statement. We've seen a couple of examples of this so far, both when we had our lesson on funding businesses. We looked at debt funding versus equity funding, but also in the last two classes, we've watched a couple of profit episodes, and we've seen Marcus asked the very question is, well, how much debt does the business have? And as we saw with Grafton Furniture, there was a tremendous amount of debt. With Corey's Cookies, there was no debt. So the balance statement gives owners or the investors an idea of how much the business is worth on a specific date. It helps answers the questions, and every business is going to have to answer these questions. What does the company own? To whom does it owe money? And then how much is the business worth? And the three terms that you're going to hear in the balance statement, and you're going to need to know these, is assets, liabilities, and owner's equity. These terms may be familiar from our discussions in class or maybe previous finance and business experience. We're going to take a closer look at each one of these terms, and then we'll get to some examples. So what do we mean by assets? Assets is everything that a business owns that has monetary value. So you can think of in your own house, or you personally, there are probably things that you own, and those things have monetary value. Those things would be considered assets. So an asset is everything a business owns that has monetary value, including, and these are just a couple of examples, cash, property, or some type of investment asset. From a business perspective, anything that the company has acquired to run the business is considered an asset. So if you can't tell by now, I like coffee. If I was going to start a coffee shop, the cups, the coffee that I would all have to acquire or get in order to run my business would be considered an asset for the business. An asset is typically a positive thing to have in the business. If you would describe somebody as they are a tremendous asset to the team or to the organization or to the group, that's typically a good thing. Okay? Now, on the other side, we have what we refer to as liabilities, commonly referred to as debt. If you remember from the Grafton Furniture episode, there is close to $1 million in debt or liabilities. So a liability is what a company will owe. And it really it's the amount of debt that a company must pay back. And they can be classified into short-term and long-term. We're not really going to get into that. But it's really any money that the business borrowed to acquire an asset. So if I need something for my business, let's go back to my coffee shop. If I need coffee or cups or lids or anything like that, how am I going to pay for it? Well, I might not have money in the business, so I might have to take out a loan or use a credit card. In any instance, I have created a liability that must ultimately be paid back. And then finally, we have what we refer to as owner's equity. It represents the owner's investment in the business. This is also sometimes referred to as just how much is the business worth on the books. So the owner's share of the assets of a business, often called just equity, it represents the value of the business after any debts would be paid. So again, we've heard the term equity before when we've talked about Shark Tank. We also talked about equity funding to start a business. So if a shark gives money, they become an owner in the business. They have contributed to the assets of the business. Again, typically when you go on Shark Tank, in exchange for that ownership, there is money to be paid. Well, that money now becomes an asset in the business. Okay? All right, so on the middle of the page, there is an example there, a very small example of how this balance statement works, and also looking at why is it called the balance statement. Well, if we look at it closer, again, assets must equal our liabilities plus our owner's equity. So on the left-hand side of the equation, we have our assets. That is what does the business own. On the right-hand side, we look at it and think, how did the business acquire that asset? So going back to the example, if I borrowed money to pay for supplies for my coffee shop, I have an asset, which is the supplies for the coffee shop, but I also have created a liability in the debt or the credit card that I used to acquire that asset. Okay, so on your sheet there, here's a really simple example. So Bill wants to start his own social media and advertising company. He puts in $10,000 of his own money to purchase an office space. And he also borrowed $1,500 to buy a new MacBook Pro. I have no idea if that's the right price for the MacBook Pro, but neither here nor there. So what do we know about Bill's very small business here at the start? Well, he has everything. He has assets, he has liabilities, and he has owner's equity. So looking at this, what are some assets that he has in the business? What are some things that he has acquired to run the business? Well, he has acquired an office space, and he has also acquired a new MacBook Pro. So in total, his assets will equal $11,500. Again, what does the company own? They have computers and they have office space. Now, how did he acquire those assets? Well, we can see there that he borrowed $1,500. Again, whether it's on a credit card or took out a loan or maybe even borrowed it from a friend. He borrowed $1,500 for the computer. But we also have to look at, well, how did he acquire the office space? Well, that was his own money. That's how much money he himself put in to the business. So in the books, if we look at the equation, then the business is worth a total of $10,000. Okay, so again, from here, you're going to work on those practice problems. I think there's about 4 or 5 of them. The last problem is a little bit more lengthy. There's a little bit more information for you. So take your time and work through those. And then once everybody's ready, we'll come back and we'll go over all of these.